Every monetary transformation in recorded history follows the same progression. First, existing systems appear stable while underlying mathematics deteriorate. Then, gradual recognition develops that mathematical realities cannot be ignored indefinitely. Finally, violent repricing occurs that reflects actual relationships between money, assets, and scarcity. For silver, we're entering the final stage of that progression. And history provides not just guidance, but mathematical frameworks for understanding where silver prices must eventually settle when monetary transformation completes. The destination isn't speculative. The destination is $350 per ounce. Not as optimistic projection, but as conservative mathematical outcome derived from historical precedent, monetary mathematics, and supply-scarcity relationships that have governed precious metals pricing for centuries. But to understand why history points toward $350 silver as inevitable rather than possible, we need to examine how previous monetary transformations resolved and why current conditions suggest resolution patterns that exceed historical precedent in both speed and magnitude. Because what's happening to silver today isn't unique in human history. What's unique is the scale, coordination, and global nature of the monetary crisis that's driving silver toward historical repricing. And historical repricing, when applied to current conditions, produces price targets that make current silver levels appear as launching points rather than destinations. The foundation for $350 silver begins with understanding historical relationships between gold and silver that have persisted across centuries, civilizations, and monetary systems. Relationships that current pricing ignores, but mathematical reality will eventually enforce. Throughout recorded history, silver has maintained value relationships with gold that reflect both metals' relative scarcity and monetary utility. These relationships, while fluctuating during short-term periods, consistently return to mathematical ranges that reflect underlying physical and monetary realities. In 1792, the United States established a legal gold-to-silver ratio of 15-1. This wasn't arbitrary government decree. This ratio reflected careful analysis of relative production, scarcity, and monetary utility that made both metals functional as currency within the same monetary system. For over a century, market ratios fluctuated around this legal standard, typically ranging between 14-1 and 17-1. Even during periods of significant gold or silver discoveries, the ratio remained within mathematical boundaries that reflected actual physical relationships between the metals. But the most significant validation of historical gold-silver relationships occurred during the 1979 to 1980 precious metals crisis. During the peak of monetary uncertainty, silver reached $49 while gold reached $850, creating a ratio of approximately 17-1. This 17-1 ratio emerged not through government regulation or market manipulation, but through natural price discovery during monetary crisis conditions. When investors sought alternatives to depreciating fiat currencies, both metals appreciated, but their appreciation maintained historical mathematical relationships despite massive price increases. Today, gold trades near $4,200 per ounce. If historical ratios reassert during current monetary crisis, silver should trade between $247, 17-1 ratio, and $280, 15-1 ratio. But historical ratios represent only the baseline for silver repricing. The complete analysis must incorporate factors that didn't exist during previous monetary crises, but dramatically amplify silver's value proposition today. Industrial demand represents the primary amplification factor that distinguishes current silver dynamics from historical precedent. Throughout most of recorded history, silver served primarily monetary functions with limited industrial applications. Today, silver serves critical industrial functions that make it irreplaceable for modern technological civilization. Electronics manufacturing consumes approximately 60% of annual silver production. Solar energy systems require silver components that cannot be economically substituted. Electric vehicle production depends on silver-intensive battery and electrical systems. 5G networks, data centers, medical devices, aerospace applications all require silver inputs that expand rather than contract as technological advancement accelerates. This industrial demand creates price support that didn't exist during historical monetary crises. When monetary uncertainty drove precious metals appreciation in previous centuries, industrial demand provided negligible price support once monetary factors stabilized. Today's silver faces industrial demand that continues growing regardless of monetary conditions. Even if monetary crisis resolves, industrial silver demand ensures sustained price support at levels that make historical precedent appear conservative rather than aggressive. But the combination of historical monetary relationships and modern industrial demand still doesn't capture the complete magnitude of silver's repricing potential. The complete analysis requires understanding how current monetary conditions compare to historical monetary crises, and why those comparisons point toward repricing that exceeds historical precedent. The 1970s monetary crisis that drove silver from $4 to $49 resulted from the United States abandoning gold convertibility while maintaining dollar-dominated international monetary system. One country's monetary policy mistakes affected global precious metals pricing because that country controlled global reserve currency. Today's monetary crisis involves coordinated money creation by every major central bank simultaneously. United States, Europe, Japan, China, all expanding money supply at rates that exceed economic growth, while accumulating debt levels that exceed historical precedent for sustainable monetary systems. When multiple major currencies debase simultaneously, alternatives become scarce relative to historical periods when only single currencies faced crisis while others remained stable. Global monetary crisis creates global flight toward alternatives, particularly alternatives that cannot be created through monetary policy. Silver cannot be printed by central banks. Silver cannot be created through quantitative easing. Silver cannot be expanded through debt monetization or negative interest rates. When all fiat currencies face mathematical sustainability questions simultaneously, precious metals become the only alternatives that maintain purchasing power independently of political decisions or monetary policy experiments. This global, rather than regional monetary crisis suggests precious metals repricing that exceeds historical precedent, because historical precedent involved partial rather than comprehensive monetary system breakdown. But even global monetary crisis doesn't capture the complete repricing potential for silver. The complete analysis requires understanding supply-scarcity relationships that have deteriorated dramatically since historical precious metals crises. During the 1970s silver crisis, above-ground silver inventories represented approximately 15 years of annual consumption. Mining production could expand relatively quickly in response to higher prices. Recycling operations could scale to recover significant quantities of silver from existing applications. Today, above-ground silver inventories represent approximately 1 to 2 years of annual consumption. Mining production faces geological constraints that prevent rapid expansion even with higher prices. Recycling operations cannot scale sufficiently to offset industrial demand growth while maintaining adequate supply for investment and monetary demand. Supply scarcity today exceeds supply scarcity during any historical precedent for precious metals pricing. When scarcity exceeds historical precedent, while demand factors amplify beyond historical precedent, price discovery typically produces outcomes that exceed historical precedent by substantial margins. Mathematical analysis of current supply and demand dynamics suggests silver repricing to levels that maintain industrial supply while accommodating monetary and investment demand requires prices substantially above historical crisis levels. $350 per ounce represents conservative estimate for repricing that balances industrial requirements, investment demand, and monetary utility under current scarcity conditions. But conservative estimates during monetary crises typically prove insufficient when panic psychology amplifies rational repricing through speculative acceleration. The Hunt brothers' silver crisis provides relevant precedent for understanding how rational repricing becomes speculative acceleration when supply scarcity meets unlimited monetary expansion. Between 1979 and 1980, the Hunt brothers accumulated approximately 100 million ounces of silver, representing roughly 10% of available above-ground supply. Their accumulation drove silver from $11 to $49 as markets recognized that concentrated ownership could create artificial scarcity. Today, global investment demand doesn't require concentrated ownership by individual families. Global investment demand reflects distributed recognition that monetary systems face mathematical sustainability questions, while silver provides alternative that cannot be debased through monetary policy. When millions of individual investors, thousands of institutional buyers, and dozens of sovereign entities simultaneously recognize silver's role as monetary alternative during fiat currency crisis, the combined buying power exceeds Hunt brothers' accumulation by factors of 10-20 or more. Distributed buying power creates sustained rather than temporary demand pressure. Individual speculators might liquidate positions for profits. Institutional buyers seeking monetary alternatives maintain positions regardless of price appreciation. Sovereign entities accumulating strategic reserves hold positions indefinitely. The sustained rather than speculative demand profile suggests repricing that establishes new permanent price levels rather than temporary peaks that collapse when speculative interest wanes. $350 silver may represent new baseline rather than speculative peak. If current monetary conditions drive institutional and sovereign recognition of silver is strategic importance. But institutional and sovereign recognition of silver's strategic importance appears to be accelerating rather than developing gradually, creating time frames for repricing that compress historical precedent from years into months or weeks. Central bank silver purchases have increased dramatically over the past 18 months. Sovereign wealth funds have begun, including precious metals allocations in strategic portfolios. Insurance companies and pension funds are exploring alternatives to bond-heavy portfolios that face duration risk during inflationary periods. When institutional recognition accelerates, institutional positioning typically occurs rapidly to minimize price impact from accumulation activity. Rapid institutional positioning creates exactly the supply shortage conditions that force price discovery towards scarcity-based rather than traditional valuation. Scarcity-based price discovery during supply shortage typically produces price levels that appear extreme relative to traditional analysis, but prove sustainable when scarcity conditions persist. Current silver scarcity conditions appear likely to persist, rather than resolve through supply expansion or demand reduction. Mining output faces geological constraints. Industrial demand continues expanding through technological advancement. Investment and monetary demand accelerates through recognition of fiat currency mathematical problems. Persistent scarcity conditions typically establish price levels that reflect actual scarcity rather than historical precedent or traditional valuation models. For silver, actual scarcity analysis suggests price levels that make $350 appear conservative rather than aggressive when compared to historical monetary crisis outcomes adjusted for current supply and demand conditions. But the most compelling argument for $350 silver comes from understanding how current monetary mathematics compare to historical monetary crisis mathematics and why current mathematics require more extreme precious metals repricing to achieve monetary system stabilization. 1970s. Monetary crisis involved debt to GDP ratios that remained manageable, while money supply expansion, though unprecedented, stayed within bounds that allowed eventual monetary policy normalization. Today's monetary crisis involves debt to GDP ratios that exceed mathematical sustainability, while money supply expansion continues accelerating to service unpayable debt levels. Mathematical analysis suggests current debt levels cannot be serviced through economic growth, while current money supply expansion rates create inflation pressures that require even greater money supply expansion to prevent economic collapse. This mathematical trap, where debt service requires money creation that creates inflation that requires more money creation, typically resolves through currency crisis that drives capital toward alternatives that cannot be debased. When currency crisis resolves through capital flight toward precious metals, the repricing continues until precious metals reach levels that restore purchasing power parity relative to money supply expansion that occurred during the crisis period. United States money supply has expanded approximately 400% since 2008. If silver repricing restores purchasing power parity with pre-crisis relationships, silver should trade above $200 per ounce, based purely on money supply expansion. But purchasing power parity. Restoration represents minimum repricing scenario. Monetary crisis, repricing typically overshoots parity restoration by substantial margins, as psychological factors amplify mathematical adjustment requirements. Historical overshoot patterns during monetary crises suggest precious metals appreciation of 5 to 10 times mathematical parity requirements. If parity restoration requires silver above $200, overshoot patterns suggest silver above $1,000 during peak crisis psychology. $350 silver represents moderate outcome between mathematical parity restoration and historical overshoot patterns. Conservative enough to account for partial rather than complete monetary system breakdown, aggressive enough to account for supply scarcity and industrial demand factors that amplify basic monetary repricing. But moderate outcomes during monetary crises depend on moderate responses by market participants and policymakers. Current evidence suggests responses may prove extreme rather than moderate, creating conditions for extreme rather than moderate repricing. Federal Reserve balance sheet expansion shows no signs of moderation despite inflation concerns. Congressional spending patterns show no signs of fiscal restraint despite debt sustainability questions. International monetary cooperation shows no signs of coordination despite global nature of current crisis. Extreme policy responses typically produce extreme market responses as mathematical realities overwhelm political preferences and financial engineering capabilities. Silver repricing above $350 becomes probable rather than possible if policy responses continue escalating rather than moderating over the coming months. The historical lens provides clear guidance. Monetary crisis drives precious metals repricing until repricing restores mathematical relationships between money supply, debt levels, and real asset values. Current mathematical relationships require silver repricing to levels that make $350 appear as way station rather than destination. But way stations, during precious metals repricing, occur rapidly rather than gradually. Silver may spend weeks at $350 levels before advancing toward mathematical equilibrium that could approach or exceed historical overshoot patterns. The progression has already begun. Current silver prices reflect partial recognition of monetary crisis reality. $350 silver reflects complete recognition combined with supply scarcity adjustment. Higher silver prices reflect psychological overshoot, combined with speculative acceleration that typically occurs during final stages of monetary crisis resolution. History provides the roadmap, mathematics provide the timeline, psychology provides the acceleration. The combination points towards silver repricing that begins with $350 but doesn't necessarily end there. Don't wait for further confirmation. History never provides confirmation until repricing completes. By completion, positioning opportunity has passed, while observation opportunity begins. Position during anticipation rather than confirmation. Historical precedent, combined with current mathematical conditions, provides sufficient analysis for positioning decisions. $350 silver represents conservative mathematical outcome rather than speculative projection. Conservative mathematical outcomes during monetary crises typically prove insufficient as psychological factors amplify mathematical requirements. But insufficient conservative outcomes still exceed current prices by substantial margins that reward positioning based on conservative analysis rather than aggressive speculation. History teaches patience during positioning and urgency during execution. Current conditions suggest execution phase approaches rapidly. $350 silver through the history lens, mathematical certainty rather than speculative possibility. Mathematical certainty requires positioning based on mathematical analysis rather than market sentiment or price momentum. History provides mathematical analysis. Current conditions provide urgency. Positioning provides participation in repricing that mathematical analysis indicates as inevitable. Don't wait longer. Mathematical inevitability doesn't provide extended positioning windows. History accelerates during final phases. Final phases approach rapidly. $350 per ounce represents conservative baseline for what approaches. Conservative baselines during monetary transformation typically prove conservative indeed. Position accordingly. History rarely provides second opportunities for positioning ahead of mathematical inevitability. The lens focuses clearly. The image shows $350 as beginning rather than ending. Beginning provides positioning opportunity. Endings provide observation experience. Choose positioning while positioning remains possible. History suggests positioning windows close faster than most people recognize. The closing approaches. $350 awaits beyond the closing. Mathematics guarantees arrival. History provides timeline. Positioning provides participation. Don't wait longer for what mathematical analysis has already determined. The history lens shows clearly $350 per ounce. Conservative mathematical outcome, inevitable rather than possible. Timeline, shorter than most expect. Positioning window closing rapidly. Choose accordingly. History doesn't extend positioning windows for individual convenience. Mathematics accelerates during final phases. Final phases have begun. $350 approaches. Position for arrival. Or observe arrival from sidelines. History provides both options. Mathematics determines which option rewards better. Choose positioning. Choose soon. Choose based on historical mathematical analysis rather than current market sentiment. Current market sentiment reflects partial recognition. Historical mathematical analysis reflects complete understanding. Complete understanding points toward $350 as conservative outcome. Conservative outcomes during monetary crises become launching points for extreme outcomes. Launching points provide better positioning than extreme outcomes. Position at launching points. $350 represents launching point rather than destination. History lens shows clearly mathematical certainty requires positioning accordingly. Don't wait longer. Positioning windows close faster than they open. History teaches this lesson consistently. Learn from history. Position accordingly. $350 awaits. Mathematical inevitability approaches. Positioning window narrows. Choose positioning. Choose now. History doesn't provide extensions.